Good afternoon, everyone, and welcome to today's presentation with Left Brain Professionals. We have Robert Jones here with us, and he will be talking about developing your first cost and price proposal. This is the fourth webinar in the series that Robert is doing about government contracts and accounting for government contracts. So it's awesome to have you with us today. My name is Liz Brigson. I'll be your host, and I'll go through our housekeeping items before I turn things over to our presenter today. So first of all, to get the most out of the presentation, I'd like to just show you a couple of quick things about that GoToWebinar control panel. So first of all, there's a questions drop down. Welcome Shane from Nashville. You can go ahead and let us know where you're joining from. And Ronald wants to know if there are any slides to download. The answer is yes. You can download the handouts directly from the GoToWebinar control panel, and you can also get them from your Incoursa dashboard as well. So wonderful, welcome everyone. Thanks for utilizing that questions box. All right, there will be 4 polling questions. There's 1 hour for the webinar today. So if you answer at least 3, you'll qualify for CPE credit and you'll be able to download your CPE certificate from your Incoursa dashboard an hour after the event wraps up. For any questions about the webinar, you can always email us at support@incoursa.com. You can find us on LinkedIn. I'm on LinkedIn as well, and it's always great to connect with you. It is my pleasure to welcome back Robert Jones. Robert Jones is the founder of Left Brain Professionals. He is a government contracts and accounting expert, and with his background, he has studied Masters of Accountancy, had roles crossing business management, compliance, operations. He's been a controller. He's also managed defense contracts, and he's really passionate about educating accountants. He's an instructor, a speaker, a soon-to-be author. So Robert, thanks so much for investing in accounting and accountants, and thanks for being here today to talk about your topic.
Great, thank you. It's always a pleasure to be back with Liz and the Incoursa team. So today we're here to talk about developing your first and cost price proposal. Quick little intro about us. We are a boutique accounting firm that works only with government contractors. We practice primarily accounting system design, implementation, and audit support, do a fair amount of training, and we also work with cybersecurity compliance because that is certainly a hot topic with government contractors. If you interact with us over time, as today you've got me, you may also interact with Melissa and Steve, other professionals on our team. Some of the tasks that we get involved with clients are things like helping them get through the SF 1408 survey, which is what you need to do in order to have an adequate or an approved accounting system for government contracts. Do a lot of work with indirect rates, cost and price proposals, the incurred cost proposal, which is coming up soon. If you're doing cost type government contracts, you need to submit that incurred cost proposal. If you are a calendar year filer ending December 31st, then your incurred cost proposal is due June 30th, which is now very, very close. Seems far away, but I'm telling you folks, June 30th is not very far away. So if you haven't started that, get started on it. And if you need help, get a hold of us. We'd love to help you. All right. We've got things that we got to cover today to make sure that you're learning something here and actually earning those CPE credits. We're going to talk about the elements of an adequate basis of estimate. We'll list the 3 regulatory limitations on profit or fee, always an interesting little conversation with people. We'll explain the purpose and calculation of weighted guidelines. And we'll identify some sources for escalation for you. That's always, again, another interesting topic, certainly when we get into negotiation. With that, I do want to kick off the first room poll here, Liz, right out of the gate.
All right, that sounds good. So the question is, how many cost and price proposals do you prepare per year? Looks like those responses are coming in pretty quickly. We'll give it about 3 to 5 more seconds here and we'll close it down. All right, and it looks like the most common answer is 1 to 5. We have a handful of folks who are in that, actually over 10% that are in the 6 to 10 or more than 10% as well. So definitely many of you, well over half of you, are already preparing cost and price proposals.
And I'm not surprised that it's a small number. I mean, that's about average, I would say, is that people really only prepare a few of these a year, which is why it's always good to go through some training like this and learn some best practices. So one of the first best practices that we have is to use a proposal adequacy checklist. In fact, if you're doing some DoD work with the Department of Defense, you will probably see this DFARS clause requirement in your RFP that says when you submit the proposal, you also need to submit this proposal adequacy checklist along with it. There are a number of items in here. We actually have, we took this and converted it, made it available to you. If you go to our website, flexbrainpro.com, and click on tools, you'll see it as a download. Actually, a little later in the presentation, I'm going to switch to our website because I want to show you a couple of tools and an Excel tool that we're going to go through later, but I'll do that all at once. But again, basically, this is a great tool that walks you through and asks you a lot of questions, some of the stuff that we're going to cover here today, to make sure that you've developed and submitted a thorough and adequate proposal. And I would tell you to take and use this checklist, even if you're not doing DoD work. You could use it for other government contracts. It could be easily modified for commercial contracts. Obviously, some of the terminology and language in there wouldn't necessarily apply to commercial contracts, but it would be a good checklist, again, to make sure that you've covered all of the important topics. So one of the things when we talk about cost and price proposals is making sure that you have a sufficient or an adequate basis of estimate. So then somebody says, well, what is a basis of estimate? And I don't typically put a lot of words on the screen, and I don't like to read to people, as you'll figure out if you haven't been with me. But sometimes there are cases like this where we really want to drive home the point. So a basis of estimate here, and I've put my bolding in here to drive this home. It's an organized set of data, key. It's a narrative information that explains the logic, methodologies, calculations, and the assumptions that you used. That is really, really important in a basis of estimate. When we talk about cost and price proposals, we're typically talking about large, not always, but we're usually typically talking about some fairly large dollar value, very complex proposals. This is not something where you put together a one-page or a two-page quote and put a top-level price and send it off to your customer. This is something that is hundreds of thousands, even in, not uncommon, obviously, to be in the millions and tens of millions of dollars, depending on how big your organization is. And obviously, when you get into large bids like that, right, there's a lot of information. It needs to be well organized. You've got to show the buyer, right? You're the seller. You've got to show the buyer and their team, how did you get there? Again, as it says here, explaining that logic, the methodology, the calculations, and the assumptions that you used, because they may not be able to make or draw the same conclusions unless you walk them through your decision process. Developing a credible basis of estimate requires, and this is really, really key, folks, reliable historical and actual cost source data. We're going to talk through a couple of methods here on the next slide about actually putting together a basis of estimate. But whichever method that you choose, you've got to have some kind of reliable historical and actual cost source data that you can use to back that up. So what is that? I mean, that's things like, obviously information from the accounting system, from the timekeeping system. Could be records of purchasing, material management, manufacturing records, right? So if you're in a manufacturing environment, you've got shop orders in your system. You have employees who are clocking in and clocking out of the shop order, so you can see the time by operation, I should say, on the shop order. You can see the amount of material and waste that occurred on a shop order. All of that is very relevant information when you're putting together a basis of estimate for a future bid. So let's talk about some of the methods. There are three primary methods here. One is the analogous method. So basically, you performed similar work, that can serve as a basis. And I will tell you, as we go through these methods, some of them sound a little similar, but there are some distinctions. Again, here you did something similar. That you can say, if somebody came to you and said, well, we need you to make widget B. And widget B, is made up of this material and it's this shape and it has this coating on it. And you can say, well, we've never made that widget B before, but we made widget A. And it was made out of the same material. It was a similar shape and size, a little different. And it also used either maybe the same coating or, again, maybe a similar coating, right? So that's where you could take that information where you made product A in the past and be able to apply that kind of information in estimating how you would make product B. A cost estimating relationship method. This is an established library of statistically valid cost estimating relationships based on, again, what? Historical data. What's a good example of this? A perfect example of this is something where it takes X amount of hours for Y type of task. One of the things that we see is that, and again, you're going to have information in your system over time, over multiple projects that you would be able to use. For example, project management. There are companies that know on average, because again, they've kept all the timekeeping, they've gone back and performed the analysis on it and determined that, for X number of hours of, direct labor work, that takes Y number of hours of a project manager to oversee that kind of work. And that would be an example of a cost estimating relationship where, again, it's something statistically valid, you've got the information to back it up, and on average over time, that remains true. That average of it, statistic remains true. And then we have the task-based or a bottom-up. Again, you said performed similar work, but you can also access a library of historical data. Not only was it similar work, but you have a lot of similar work that you can pull stuff together. This might be a situation where you do modular kind of work, so somebody comes to you and it's kind of an a la carte menu of the product that you make or the services that you perform, and somebody comes to you with a contract and they want services 1, 4, and 7, and you've performed 1, 4, and 7 before on other contracts, and again can pull that information over. But because this particular contract is a little different, right? You're going to have to go task by task through there, but you've got task by task information somewhere else that you can pull in. So even at a top level, if I compared maybe those two contracts at a top level, those two contracts wouldn't necessarily look the same. But I have, again, task level information from multiple contracts that I could pull over and use to build up my basis of estimate. Another method is the level of effort method. So there's a predefined level of support for some task, such as an allocation of hours, again, for project management, quality assurance, or supervisors. Very common thing. You may have contracts that you're bidding where the client has said they want a specific level of effort, right? They might say, we are hiring you to do this service, and we want you to provide coverage in the case of a staffing type of thing, where they might want a very specific, hey, we have a call center we want you to manage, and that call center is going to be open so many hours per day and so many days per week, and and it's open, maybe it's open 24/7, 365, or whatever the case may be, and and they can give you call volumes. You can take that combined with the previous cost estimating relationship information and align that, okay, for this kind of call volume, we need this many people answering phones. If we have that many people working X number of hours, we need Y number of supervisors. All of that kind of information that you put together to build up your basis of estimate. The last one here, and note that this is my note in the parentheses, this is the least desirable. Please do not just say this was engineering professional judgment. That is something that will irritate, I assure you that's going to irritate the cost analyst on the other side when you send that over. Yes, you're saying, well, but they're an engineer, they're smart, they're intelligent, they know how to build this, but you are relying on their technical expertise, which is good, but you don't have any historical data to back it up. So basically what you've said is, you took an RFP or a statement of work and you gave it to an engineer or maybe a group of engineers, and they went through and said, well, I think if I had to do it, it would probably take about this much. You know, they're making their best guess based on their judgment. One of the better methods would be one that we've already discussed, where you could say, the client wants to buy this product or buy this service. We've provided that product or service before, either in the same or a similar format. And when we did that before, it was X hours or Y dollars or whatever the case may be. And it might be a one-for-one translation, or it can be a situation where, again, maybe somebody wants to buy product B, you've made product A. You use product A because it was very similar for your estimating purposes. It's easy to carry that information over, but obviously you would want to talk about what the differences are between product A and product B, so that if I'm the cost analyst on the other side and I'm trying to understand this, I can see, oh, well, product B is, you know, X% larger or smaller or whatever the case may be. And so that would be how or why you adjusted some of your numbers. With that, Liz, we've got another polling question here. I'll let you kick off for us, please.
All right, that sounds good. So a basis of estimate is a list of items or tasks with calculations in dollars. You can read number 2 and number 3. The response for number 4 is a little bit longer, and we got a little bit truncated. So let's make sure we can get that full answer. And so the last response is a list of items or tasks with quantity hours, descriptions, calculations, dollars, and references. So looks like about 70% of the audience has responded so far. So we'll give it just a few more seconds here to get the rest of those responses in. Very good. Thank you, everyone. Well, it looks like just over 60% of the audience did respond that 4th choice.
Yes, and that is the correct answer. So the others sound correct, and I guess this is like one of those SAT questions. Which one is the best answer? I sometimes like to trick people up when I write some of these questions. Yes, a basis of estimate is a list of items or tasks, and it would have calculations, dollars, descriptions, and quantities in hours, and that last item that was part of D there, references, right? We said you need to explain how all of this information relates together and where you pulled the information from. That's going to be the other part of your references. All right, so let's talk about some of the primary cost elements when we're putting together a cost and price proposal. Labor, right? Labor is a big part of any company's expense. You're going to want to have labor categories in there. Again, depending on the contract in which you're bidding, what the RFP details are, they might actually tell you what the labor categories are. They might say, we're buying these services from you, and in these services, we want these 10 labor categories or 12 labor categories, whatever that may be. Those labor, in that situation, you want to be very, very careful because the government, and unfortunately, and this is why you need to be careful, I'm getting stumbled a little bit. You want to be careful because there's no set prescribed criteria for any specific labor category. And you might say, well, if I'm doing business with the government, doesn't the government always agree what a senior systems engineer is? No, not necessarily. As you go from agency to agency and office to office, program to program, what qualifies as a senior systems engineer on one contract may have different qualifications on another contract from another agency, okay? So you want to make sure that if there are predefined labor categories, you know what those labor categories are, and that you are mapping your internal employees based upon their education, experience, and certification to the appropriate labor categories. You want to make sure that you identify any temporary labor that you might be using as part of contract performance. And that could also be any subcontract labor. We will talk about subcontractors a little separately, but again, you could have internal labor, you could have temporary labor, and you could separately have subcontractor labor. And you know, we're talking about labor, and I'm saying manufacturing reports. Remember when I said that a lot of companies have their ERP and MRP systems? So ERP is Enterprise Resource Planning, and MRP is Material or Manufacturing Resource Planning. They have shop orders in there, and hopefully if you're using shop orders, you actually have employees clock in and clock out of each operation in the shop order. And what does that give you? That now gives you the actual time to perform those operations or those tasks. So now you have statistical information that you can go back and say that when we make widget Y, and let's say widget Y has 5 operations on it as part of the assembly, you know that operations 20, for example, on average requires X amount of time to do it. So if somebody comes to you, wants to buy widget Z, which is similar to widget Y, and it has some of the same or similar, again, assembly kind of work on it, you can say, well, based upon widget Y, it takes us on average this much time to do the assembly. So on widget Z, it should take, again, either a same or similar amount, and you would have the information to justify how you got to that number. Material, again, if you are providing a product, material is a big part of your proposal. If you're providing services, material may be a small portion of pass-through kind of stuff. Our general, this is not necessarily a hard set in stone regulatory requirement, but our general guidance is that you have quotes to support at least 80% of the cost of material, right? So you want to be able to show, and those are your big dollar items, right? Those are the ones that are going to be questioned. So you might have a bill of material, again, depending on how complex the product is that you're making. It could be a few items, could be a few hundred, could be a few thousand. I used to work in an environment where our average product had about 4,000 items in the bill of material, a pretty complex product. So, but when you look at that and you look at that from a cost perspective, not a quantity perspective, you usually find that 80% of the cost are, somewhere around 10 to 20%, maybe even less, but usually around 10 to 20% of the volume or the number of parts. So you want to make sure that you've got quotes to support that kind of information. Again, actual manufacturing reports, if you're on a standard cost environment, you want to be able to show that you are updating those standard costs over time. So you don't want to be in a situation where you created or developed your standard costs 5 years ago, but you've never gone in and updated those standards for any changes in material costs. You want to be able to show that you've got that appropriate information. If your work requires travel, you'll want to know the location, the number of travelers, number of days, and number of trips. So for example, it might be something where you're making a product and you're going to have the product delivered, and then you send a team out to actually install and test and maybe train users on how to use the product. So you need to know, where are these travelers going? How many people need to go? How long are they going to be there? How many trips are involved in it? It might be a situation where you're training a number of people over time, and so there are multiple training sessions or whatever the case may be. You're going to have to use estimated airfare, rental car, fuel, parking, and tolls. That's the best that we can do. Those numbers, if you look today and come back tomorrow, come back next week, next month, all right, we know that those estimates do change. But the best thing that you can do is at least go out and, try to get estimated airfare. If you got to be in Spokane, Washington, and, I'm in Columbus, Ohio, I could look and get at least an estimate today and kind of know what that is. When we talk about per diem, which is that reimbursement, well, it's not necessarily reimbursement, you're providing per diem for the meals and incidentals and for lodging, make sure you pull those GSA. For government contracts, go to the GSA website and make sure you know what the lodging limit is and what the per diem is for that location. Remember, that is location-based. I put in parentheses here from the lodging perspective, you'll have to estimate taxes and fees. Remember, those are all, as long as your lodging is under the GSA limit, it's an allowable cost. The associated taxes and fees are always allowable, even if it puts the total of the lodging over. It's the base lodging that is key. And so again, the best that you can do here is to estimate your taxes and fees. Some other items that are part of our primary cost element, ODCs or other direct costs. Again, these are kind of those incidental things that may pop up from here and there. You may not be able to provide any estimates because they might truly be so small that we don't know what they are and we'll just deal with them as they come up. Or you might know that on average, for example, when you do installations that, some ODCs might be, for example, extra cables or shims or some other kind of, again, small notional kind of expense, and you might be able to estimate those up front. Your subcontractors. So when I mentioned labor, I said subcontractors are a big factor. We identify those separately. Keep in mind that you do need to obtain, and now there certainly are some exceptions to certified cost or pricing data. That CCPD there is certified cost or pricing data. And you may have a subcontractor who is exempt from certified cost or pricing data, and I always make that distinction of the certified. They may, but you may still need to require them to submit other than certified cost or pricing data. Keep in mind that it may be exactly the same data. It simply doesn't have the certification tied to it. And when I say simply, I'm not minimizing what certification is. Certification is actually very, very important. But if they do have an exemption, they may still need to submit other than certified cost or pricing data. And keep in mind that you'll need that for any proposals that exceed the truthful cost or pricing data threshold. That used to be TINA. I jokingly used to say for a while that TINA lost her crown, and now it's the Truthful Cost or Pricing Data Act. Currently, that threshold is $2 million. There's another little threshold that some people overlook or sometimes forget. You do need to provide the CCPD, or again, other than certified cost or pricing data as appropriate, and the written analysis for any proposals exceeding $13.5 million or 10% of your prime award. Very, very important. So let me try to get a number here in my head. Let's say you're putting together a $4 million proposal, and one of your subs is $750,000. Well, $750,000 is not more than $2 million, that threshold, but $750,000 is more than 10% of your award, right? $4 million award, 10% would be $400,000. So you need to provide that additional detail. That means that written, and note that written analysis. That means somebody in your organization needs to actually perform cost or price analysis and write out all that documentation, right? In this case, we're talking about cost type of stuff. They would need to do that cost analysis and write that out and include that in your proposal up to the government. Very key thing, again, that some people overlook. Primary cost elements, we start talking about indirect costs. So indirect costs, right, are those fringe overhead and G&A, and hopefully you've been with us on some of the previous webinars here with the Incorsa team. We actually did 2 webinars, one on the fundamentals of indirect rates and one on advanced indirect rates. If you've been in the series with us, hopefully you're seeing how this progression comes together. So we talked about how you develop those rates. Well, guess what? Now you got to apply them, right? You're going to put them together in this cost and price proposal. So you need to be able, you're going to have to show how you got your rates. You have to show what they are and include them in here. So one of the best ways to do this, though unfortunately a lot of people don't have access to this, is to have a forward pricing rate agreement. That's actually a separate specified agreement with your cognizant agency, typically DCAA. They come in, you provide them essentially your budget. You do this ahead of time. They go through and you guys negotiate and come to a set agreement. That is your forward pricing rate agreement. It is its own agreement. You can then use those rates for the period identified in the agreement, and you put that in all of your contracts. And your other contracting officers and stuff essentially have to accept that because those rates have been reviewed and have been negotiated on behalf of the government. Again, especially when we talk about small businesses, they don't have forward pricing rate agreements usually. But these are typically large companies that are doing lots and lots of work with the government that actually have a true forward pricing rate agreement. So what's the next best thing? have approved provisional billing rates. That's where you've built your budget and you've submitted it to the contracting officer, and they have given you approval to use those provisional billing rates. So you've got essentially a stamp of approval at a lower level, an agreement to use those provisional billing rates. You may have that approval from one contracting officer, potentially from one agency. Can you take and use that in another agency? Well, the answer is yes and no. It's still up to the other agency to accept it, but I will certainly say that having approved provisional billing rates and having documentation of that and being able to take to another agency is very helpful, because again, then it shows at least this other agency or that other contracting officer, right, that you've done the right things and somebody else has looked at these rates. However, getting approved provisional billing rates doesn't always happen. So now what's the next best thing? You know, a good example is to have your own provisional billing rates. It's essentially the same rates. It's just that nobody else has signed off, reviewed, or approved those in any manner, and that you would have built those from a budget. We'll be talking about budgets in another webinar coming up in this series, and we'll talk about how to actually, so we talked about the structure of rates previously, but we're going to soon be talking about actually putting together the budget and then applying it to that structure that you've created. So a little phrase here that I learned from somebody that I really admire and respect. I think she stole it certainly from somewhere else, but it's a wonderful little phrase: good, better, best, never let it rest until the good get better and the better get what? Does anybody know what the blank is? I know you guys can't talk to me. You can put it in the chat. Good, better, best, never let it rest until the good get better and the better get what? Best. So you want to strive to, at one point, did you grow up big enough to be able to apply and get a forward pricing rate agreement? But in the meantime, you can at least make sure that you're building good provisional billing rates from a budget, and hopefully that you get those approved by a contracting officer. All right, facilities capital cost of money. This is an interesting topic. When we get to, and I know, again, we're going to have another webinar, there's so many things that we've got in, which is why I put together this series of 12 topics throughout the year. And honestly, even within the 12 topics, we could probably make many of these 1 hour webinars into 2 or 3 hour webinars, because there's so much information. We will be talking about unallowable costs in the future, and one of the unallowable costs is interest expense. So the government doesn't allow you as a government contractor to include interest expense back to the government. So if you go out and, for example, take out a loan in order to buy equipment, to buy a building, whatever the case may be, you cannot include that interest expense back to the government. What they have done, however, is created this facilities capital cost of money. The government recognizes, right, that you are tying up capital, whether it's your own capital or whether, you know, you've gone out to borrow money to invest. You've tied up money, and that's costing you, whether it's costing you directly because you're paying interest to a financial institution, or it's costing you because you've tied up your own capital now, right, and you can't invest that capital or spend it in other ways. So they've given us this facilities capital cost of money, and basically what it is an imputed, and this is my terminology here with the quotes, interest-like expense. It is an imputed interest-like expense, since interest is an unallowable expense. And I'm going to show you a couple of scenarios. This is where I'm going to switch gears to Excel and show you a couple of things. But essentially, you multiply the book value of the capital employed, which would be those assets, by the applicable treasury rate. There's a couple of key things in that phrase right there. The first is the book value. And for all my very, very smart accountants out there, what happens to book value? What is book value, first of all? And what happens to book value over time? Book value, right, is the cost of acquisition, right, the historical cost minus depreciation. And so book value of an asset over time decreases, right? If I spent $20,000 buying a car and or, you know, vehicle or a piece of equipment, whatever the case may be, and that has a 5-year life, let's say with no salvage value, so that's $4,000 in depreciation at the end of at the end of year one, the book value of that item is now $16,000. So one of the things that gets business owners frustrated with this facility capital money is that you're calculating interest on something that is declining over time, even though your money may continue to be tied up, right? So for example, you could buy a building, your cash is tied up now in that building. The only way you have access to the cash is to sell the building, but the book value of the building is going down over time. So we've got a screenshot here to kind of show you what the calculator is. We do have a template that's available for you to download. I'm going to switch my screen here quickly and give me 1 second. So if you come to our website, both of the tools, remember I said that the proposal adequacy checklist is out here. If you come to leftbrainpro.com and click on tools, you'll see proposal adequacy checklist, which I have here on the screen. It's that list of items. You can also download an Excel copy of it. And then for the facilities capital cost of money, I don't have, on some of the other calculators, we've developed a web version. This one was more difficult to do. You can download the Excel version, which I'm going to switch gears here and show you. And let me make that a little larger because I'm on my big 4K monitor, and it looks perfect to me, but I realize when people are viewing through webinars, you need to get it bigger. So really quickly here, again, this is a template. This is one of those tools that would definitely, and you can download it, you can use it. If you need help modifying it, please contact us. It's not super difficult, but it is a little tricky. And one of the things that you need to make sure is that you're updating the rates. And so you see that there's a rates tab here. These are the Treasury rates. You go to the Treasury. We've given you the link right there on the tool in order to get the updated rates. We've updated this to the most current rates. We have historical rates out there from 2012 forward. As you move forward in time, the Treasury does update these rates every 6 months, and so you want to make sure that you update the tool so you have the most recent information. You can create a list of your assets here. We've built the formula in to calculate what the depreciation is, as long as you know what the depreciable life is of the asset. And then you can come over here and start looking at the book value and the cost of money. So in my example here of the building, again, what's happening to the book value of the building over time? The book value is decreasing over time. And then one of the other things that's an issue is the Treasury rate. Now, it does fluctuate. The Treasury rate doesn't necessarily go down over time, but it does go down at times, right? It goes up, it goes down. So, but unfortunately, you're taking that rate and you're multiplying it by a book value that is decreasing over time. And in fact, the proper calculation here, we've got the information in here for you over the average net book value of the year or the time period that's involved in the contract. So you do need to do this for the assets that are involved in a particular contract. And obviously, the period of performance of the contract would alter this potentially. But you can see that the cost of money that's allowed to me, even though I've invested in my example here, $450,000 in the building, and my money is tied up, either whether I'm borrowed that money or I've invested my own money, my return that I'm getting through this cost of money is smaller. The stuff at the bottom has to do with related party allowable rent. It is related to this, which is why we've got it in the tool, but that is a specific topic that we will cover in the unallowable costs. If you do have related party rent and you need help with that, this tool will help. Again, contact us. We can walk you through the proper way to calculate those costs. So let me get back here to the presentation and get my mouse going. There we go. Just a couple other screenshots I showed you already in the Excel tool, but again, you can enter the information for your assets. You want to make sure that you enter the information for the updated Treasury rates so that as you're going over time, you're calculating the proper cost of money. Other big elements this is not necessarily a cost element, but another aspect of putting together the an adequate basis of estimate, an adequate proposal. It needs to be time phased. So that means that you need to have hours and dollars by task or plan by year. So let's say you have a situation where there's whether it's a predefined level of effort or somebody is coming to you to buy a product or service, very rarely in these types of things is the level of effort equal and even through the period of performance. Quite often, right, we see blips up and down, particularly, one, we can see that overall, right, that we may have to do a bunch of work and maybe we have to maybe we were waiting on another contractor to do their part of the work or somebody else, and then there's work and then it slows down. And that can even happen within labor categories, right? You might have a situation where you have a bunch of designers do work on the front end, but then it drops off because now somebody else is going to do work. So that particular labor category falls off, but another labor category spikes up, right? So you need to be able to identify that. Again, hours and dollars by task or CLIN by year, because you also need to be able to provide subtotals of that information. You want to see subtotals and totals by labor category, by year, or by CLIN and by year. Again, and within a CLIN, you may have multiple labor categories potentially within a CLIN. Giving you the information there. And I've got a really simple example here. We've got a polling question coming up next, Liz, if you want to be queued for that. But a really simple scenario that I've given you here. You see that there's 3 years, 2021 and 2022. And I see something got cut off that was supposed to be systems engineer 1, 2, and 3. I apologize. I see that got cut off there. But anyway, 3 different labor categories, 3 different rates. The hours by year are different. Also notice that the rates by year are different, right? Typically we have escalated rates as we go out. That's another reason why we need to make sure this is time phased, because we want to make sure that we're multiplying the rates used in a year or in a period by the proper rate that has the proper escalation tied to it. You'll see that my little mini proposal here has labor, materials, and travel. And if you look, you see that I have subtotals for labor, subtotals for material, and subtotals for travel. I also have totals extended all the way across so that I can see total hours and dollars by labor category, by material type, and by travel item. I can see totals across the very bottom by year, and I can see a total in the lower right-hand corner. That is everything for all years for all CLINs and items. Again, very simplistic approach here on a one page, but this is the kind of detail that you need to put together in a cost and price proposal. With that, Liz, if you'll kick off the third polling question for us, please.
All right, sounds good. So, which of the following is not a primary cost estimate? And let's see if we have any questions. Yes, all right, so it looks like we have a question about what is an example of a contracting officer? And then also, what is CLIN? And it looks like
so
Jenny
contracting officer. Okay.
But
I was going to say, I can answer really quickly. Yeah, so contracting officer is going to be basically the buyer's representative at the government. That's the person at the government who actually has a warrant. They are authorized to bind the government. They're authorized to make that commitment to a contract. And they're the ones that not only authorize the buying, but they have a lot of other authorizations, such as approving rates, approving accounting systems, and other stuff. And then a CLIN is a contract line item. CLIN is a contract line item. Basically, think task, right? If you got a project and you've got 5 tasks underneath of it, you could get a contract that would have 5 CLINs. And a CLIN can either be for an individual product, or can it be for an individual service or milestone or something like that. And
awesome.
It looks like, go ahead.
Yes, so sorry about that, Robert. I think you're probably going to comment on the responses to the poll, and I was just going to mention to the audience that Jenny from your team is online, and she'll help to facilitate the Q&A at the end. So with that, I'll go ahead and pass it back over to you.
Yeah, looks like 81% said contingencies, and that is the correct answer, right? While contingencies are a real thing, and many of us are living through that today, right? And who knew that COVID-19 would hit, or what the impact would be? So we're all living through a lot of contingencies right now. You can't put a line item on your contract that says contingencies, right? You can't put that in your proposal and say, this is the what if, right? We know it happens, but it's not a primary cost element. So let's talk for a couple of moments about profit and fee. I know I've got about 15 minutes left in our hour. I want to save at least a few minutes at the end for some Q&A. Let's talk about profit and fee. I bet many of you, I should have put this as a polling question, or certainly if you want to throw something out there in the chat or the questions, I bet many of you have heard, oh, when you do government contracts, you can't charge more than 8%, or you can't charge more than 10%. I bet some of you, if you are doing work with some primes, if you're a subcontractor, I bet some of your primes have come to you and said, we're interested in working with you, but we only pay 6% or we only pay 8%. Unfortunately, I'll say those are true statements. They happen. Unfortunately, they are incorrect. There are primes out there who jump in and say, yeah, I'm only going to pay you 6% or 8%. And unfortunately, in that situation, as a prime and a sub, you are in a B2B contract that is governed by the UCC. It is not governed by the FAR. While you do have FAR clauses that come into play, it is a B2B government contract. I mean, it is a B2B contract governed by the UCC or the Uniform Commercial Code. It's not governed by the FAR. The FAR governs those contracts between the government and the prime, though again, we do include FAR clauses in subcontracts. But there are only 3 limitations. I'm going to get to those in a moment. I want to talk really quickly first, though, about how we should be thinking about profit and how the government and primes should be thinking about it when they're negotiating with contractors. Right? Profit is supposed to be a motivator of efficient and effective contract performance. Right? Particularly when we look at like fixed price contracts, somebody takes more risk, a contractor takes more risk to do a fixed price contract. And so they should get more profit or fee out of it, right? And be a motivator. And in fact, there are incentive type contracts out there where we increase the profit in a contract when a contractor is more efficient and effective at contract performance. There are ways to further incentivize contractors. And some of the stuff that I'm getting, the quotes that I'm giving you here, this is straight out of the FAR, that FAR reference up there. Negotiations aimed merely at reducing prices by reducing profit without proper recognition of the function of profit are not in the government's interest. And so the other piece to tie to that is without, adjusting the scope, right? Yes, do people get into negotiations? Is ultimately your customer or your client not happy with the price and they want to reduce the overall price? That's fine, but we can't just say we're going to negotiate away profit. If we're going to negotiate price, we should also be negotiating scope or other elements that are part of the contract. Again, straight out of the FAR here, I didn't make this up. This is the terminology straight in the FAR. Negotiation of extremely low profits, use of historical averages, or automatic application of predetermined percentages of total estimated costs do not provide the proper motivation for optimum contract performance, right? So predetermined, right? Just saying when you have that situation, and we've seen it from the government, we've seen it from the prime at times, where they come in and say, we're only paying 6%, we don't care, or we're only paying 8%, we don't care, we're not going to negotiate, right? That's not even what the FAR says. The FAR says when you walk into it like that, that is not the proper approach, and you're not providing the proper motivation for optimum contract performance. So it's important to note that profit or fee does not equal net income. This is one of the conversations I've had to have with non-accounting folks in the government. They don't always understand really what profit or fee is. They think, well, if I negotiate 10% profit or fee to a contractor, then they've got 10% of money they can put in their pocket. Well, that's not necessarily true. Contractors' actual realized profit or fee may vary from negotiated profit or fee. There are a number of factors such as efficiency of performance, incurrence of costs that the government does not recognize as allowable, and the contract type. Again, if a fixed price contract, which you shouldn't be negotiating fees separately anyway, but that's one of the risks for the contractor, right? Whatever they figured out as their fee that they calculated in there, the risk that they take is that they may not make that because of cost overruns or other items that are a risk in the contract type. items that come out of profit. Hopefully most of you on the accountants here on this webinar know this, but again, I have to drive this home to the non-accounting people out there is federal income taxes, right? Come out of profit. That we can't charge the government back for federal income taxes. Unallowable costs come out, right? Again, they're unallowable. They can't be included in the rates. So where do they come from? They come out of that profit and fee that you negotiate. And things like an unallowable costs, examples that I've got here for you are interest expense, charitable contributions, employee welfare, cost overruns, right? You can have you can even have situations on cost type contracts where a cost overrun is not cost reimbursable. And you might say, well, it's a cost type contract. Well, again, there can be limits to those costs. There could have been costs that were incurred outside the period of performance. There could have been unallowable costs that were defined in the contract, the use of improper labor categories, a number of things that can happen even in a cost type environment where those costs are not billable back to the government. Uses of profit. Again, for my non-accountants, I always have to explain to them, well, what exactly, just because you, as the government, for example, the contracting officer, let's say you negotiated 10% profit or fee with somebody. Again, that doesn't mean that at the end of the day or at the end of the month, they're taking 10% of the invoice and putting it in their pocket and walking away with it. We talked about some of the stuff that already comes out. So they're not even getting 10%. They may only be getting 8 or 7.5, or, once you take out those other costs. But then what are they doing? Again, even when that's the case, they can't just magically take the 7.5% or whatever that was left out at the end of every month. Why? Because they need working capital. They can't just rush and take it out. That working capital is used for internal investments, for funding growth and other contracts. My term here is floating AR, right? So I have situations where I'm doing work on one contract and I'm waiting, and I may be using the cash flow from that to cover another contract while I'm waiting to get paid. Maybe I already did the work on another contract. I submitted my invoice and now I'm waiting for payment. But I've got other work that I need to keep doing, right? So essentially I'm floating my accounts receivable. I have owners and investors that they want paid back, right? They took a risk and so now they want the reward. People who, companies go in business to make money, and investors expect a return. So what are these limitations that I've hinted at? Again, there are 3 very limited ones in federal contracts. One is R&D work on cost plus fixed fee types of contracts. That shall not exceed 15% of the contract's estimated cost, excluding fee. For architect, engineer, or AE works, this one is a little wordy. Basically, I'll break it down to you. It essentially says that the AE contract cannot exceed 6% of the actual construction work. It doesn't say 6% fee. It simply says that the architect engineer, right? So that's the person that's designed, let's say it's a new bridge, right? And so there's going to be public funds to construct the bridge. This says that the architect engineer contract cannot exceed 6% of the estimated cost of the construction of the bridge itself, in my example. And then the other one is for all other cost plus fixed fee. Note fixed fee because we do have cost plus award fee and cost plus incentive fee type contracts. We did not talk about fixed price contracts or T&M in here at all, okay? So for all other cost plus fixed fee contracts, the fee shall not exceed 10% excluding fee. Another factor that comes into play, and I'm speeding up a little bit because I got a few more slides, and we got to get to some Q&A. There are weighted guidelines if you're doing government contracts that government contractors and primes will use to develop a fee position. And there are 4 profit factors involved. It's the performance risk, the contract type risk, the facilities capital employed, and the cost efficiency. Let me back up for just a moment. When I talked about the facilities capital cost of money, I forgot to mention something very, very important. You cannot claim cost of money on your incurred cost proposal at the end of the year if you did not propose it and include it in that proposal and that contract. Let me say again, you cannot claim cost of money if you did not propose it. Very, very important piece of information. There is the DD 1547. I'm kind of going through this because I want to get and show you an online example. So you can download the DD 1547 It's a little clunky, but the nice thing is that there are some online tools. One of them is from SpendLogic. This is a company that we've partnered with. They have some software and some services that they sell. This is a free tool that's on their website. If you go to SpendLogic and you see over there that resources, if you click on resources, you can get to this free weighted guidelines calculator, and it walks you through how to calculate. It's going to ask you about those different categories that we talked about. You're going to identify, was it above normal, below normal risk, all that kind of stuff. And then it's going to walk you through and give you a total. And when you do that, then you can print that out and save that in your records. Escalation is a key factor in negotiating price. Ideally, you're separating your labor and material because there can be differences, especially with certain types of raw materials, where the escalation factor applied to a specific raw material is significantly different than the product overall or the labor that was related to using that material. Labor can vary by category and by geography. So again, you may want to look at making very specific breakout of labor for escalation purposes. Material varies by commodity. And essentially what we're driving here is a single factor alone may not give fair consideration to any of the individual components. While many companies do negotiate a single factor approach to escalation, if you have something underlying that causes a swing, you should look at breaking out labor and material and getting a little more arbitrary. It's important to note that arbitrary round numbers are not acceptable. You can't just say, well, we're going to do 3% or 5% and apply that across years. That's always a flag to any cost analyst or auditor out there, and they're going to jump on that. You need to show variation among the years. That doesn't necessarily mean 2.1 or 2.9, 3.0, 3.1, right? That's not the right answer either because they all look pretty close to 3 and it doesn't look like you really did much effort to figure it out. You've got to figure out year by year with the best information that you can what that escalation is. A couple of quick things here. I'm almost near the end, folks. There's IHS Global Insight. It's a very powerful tool. It's used by the government and many of the large primes. It has historical information in there along with projections. It is very, very expensive, and the average person like me and you simply can't afford access to the tool. So what else is there? SpendLogic, again, has another great tool. You can go to their website. This is a free tool that you can use. And you simply choose the index. So you look at the type of labor or material. You input the period, the starting and the end date. So you use the period of performance in your contract. It gives you the information. Theirs is based upon historical information from the Bureau of Labor Statistics and other historical information. And then they built their own algorithm to look 18 months into the future to try to predict what these rates will do. So you do have that. It is free. Again, you could print it out and use it, include it with your proposal. Whatever escalation you come up with, you want to document, again, how you got there, that whole basis of estimate approach. The Bureau of Labor Statistics, you could go look this up yourself. It is historical in nature. There is nothing forward-looking. With that, Liz, I know we're down to the last couple of minutes, and we've got our final polling question here.
Sounds good. That's up on your screen. How confident are you in the quality of your cost and price proposals? All right, and as we're just giving it the final few seconds, we'll take a look. We'll close this down and take a look. We have some highly confident folks with us. No surprise, a lot of you fall right in those two middle options.
Yeah, and so, obviously if you need help with this, contact us, support@leftbrainpro.com. We can help you out, whether it's, again, with the cost of money calculation or something else. We'd love to help you. Let me get through a couple of other slides here. I know we got some questions. I will say that if we don't get to your question today, we do get those and we will email you an answer to your question. Simply say here that these can be very complex scenarios. Again, the larger the dollar value, the more detail and information that you want. With that, we can start queuing up for the Q&A here. Contact us. You can find us online. You can find us on social media. We have additional events coming up. In fact, we will be, again, coming up on course in another few weeks with the next topic. So with that, I guess we can try to take a couple of questions here.
Okay, the first question we have, and you might have to refer back to the slides, is on page 34 of 52. Why are these not considered operating costs? In other words, the taxes.
So it's not that they're not operating costs, it's that when we're dealing with government contracts, there are things that we're dealing with what are referred to as allowable and unallowable costs. Those are dictated in FAR 31.205 is where they're enumerated. So there's basically unallowable costs or costs that the government deems that are not required in order to perform the contract. They may otherwise be legitimate business expenses. They may, and often, not always, often are tax deductible for IRS purposes. But this is not a tax course. This is not about IRS. This is about government and what's allowed to be included in your rates when you bill those back to the government. Again, we're going to have a specific webinar on that coming up. I don't know the date off the top of my head, but if you follow up with unallowable costs, there will be some additional training on that.
Okay, do we have time for another question?
I think we can have time for one more.
Okay.
For anyone who'd like to stick around.
I've got one. We've been asked to bid on developing a new technology, not through a SBIR contract. How would you suggest we document our assumptions and resulting information that is not included in the formal BOE?
My simple answer is document, right? So whatever you used, and that's such an excellent question. There are times where there's additional information that you use to develop your price that may not be included in the proposal. Let me give a cautionary, let me give everybody a little bit of caution to this though. If you're in a situation where you are required to submit certified cost or pricing data because you're over that threshold and you otherwise do not have an exemption to certified cost or pricing data, you have to provide all of that. You have to give everything that you use to develop that price to the government because they want to go through and make sure that they come to the same conclusion that you do, and they're going to use that as part of negotiations. If you fail to, if this is a certified, stress that, certified cost or pricing data situation, and you fail to provide that information, and that information is later determined to have been available, that it was used, and that it had an impact on pricing and negotiations, the government can come after you for defective cost or pricing. And that is very, very serious because essentially you could end up in a situation where you overpriced the government because you didn't share all of the appropriate information. That caution aside, there certainly are times where, again, whether you're putting together a fixed price quote, you might be putting together T&M, you might be putting together something that is not above the threshold or that otherwise doesn't require certified cost or pricing data, and you have other information. I can't stress enough the importance of keeping all of that stuff together so that when somebody comes back, you can understand how you got there. Because the problem a lot of times is that these things occur over many months, sometimes even over years, right? You might propose something that could be months later before you negotiate, maybe months after that before you do work, months or years after that before the project is complete. And at some point, somebody wants to go back and say, well, how in the world did we ever come up with that cost or that price? So as much information as you can keep, the better.
Wonderful.
Okay,
Well,
we do have another. Did we have time for one more, or should we follow up?
Well, I want to make sure that we keep to, for the audience, for everyone who's joining us, let's go ahead and just quick do our housekeeping items. And then, Jenny, if you want to let us know who that question came from, and if Robert has time, we can stick around for a few minutes longer. Just to close out the housekeeping items, there will be a short course survey following the program, so we really appreciate your feedback. And then you can log into your Incorsa dashboard to access your CPE certificate if you answered at least 3 of those 4 questions. The recording and the materials will be available for your access later. And then, as Robert mentioned, he will be back with us in May, and the topic next month is going to be cost accounting standards. So we're really excited to have you back, Robert. For everyone who has a hard stop, thanks so much for taking the time to join us. Thanks for sticking around. And then we'll go ahead and just take that one last question before we close out for the day.
Okay, the one last question is, can you apply fee to T&M contracts?
So a T&M contract, a time and material contract, is a situation where you have developed the price per labor category. So usually in a time and material contract, the government or the prime is coming to you and they're buying services, right, predefined labor categories, and you have a price, you have a top level price that's included in there. I have seen situations where the fee or profit that was used to calculate that price has been negotiated. I'm not going to say that's the right answer or the wrong answer, because I've also seen plenty of times where that fee was not negotiated. So typically you should have developed your top level price with whatever is an appropriate fee or profit for your industry and for the type of work. Whether that gets negotiated by the prime or the government is kind of a separate situation. And my last comment, that'll be, it's also going to depend a little bit on how competitive you are to others in the marketplace with that top level price.
Very good. Thank you so much. Robert, thanks so much for another fantastic presentation. And Jenny, thanks for joining us to facilitate the Q&A as well. Well, it's been wonderful to have you all with us today. A great topic. Look forward to having you back in May. Until then, stay safe, stay well, and we look forward to having you with us again soon. Take care, everyone.
Thank you.